pretty clear that the more gradual an increase in interest rates is, the easier it is for the financial sector to deal with it. So any abrupt change in interest rates would expose vulnerabilities in the banks, in the insurance sector, and also in the fund sector. But let me emphasize that an abrupt increase in interest rates is not purely. We're not looking here at a monetary policy shock, but it can come from the markets. So in that sense, we're looking generally at how exposed is the financial sector to interest rate risks, and we're seeing that abrupt changes in interest rates do have an impact on the financial system. This is what I mentioned earlier, why we need sufficient buffers in the system across all the institutions to deal with it. But this is not a statement about specific monetary policy actions being taken.
What about small tweaks, though, to monetary policy? Because also on the radar is whether the ECB has to move quicker than what was anticipated, maybe with a small tweak to monetary policy later on next year in about 12 months' time. Doesn't that address some of the concerns that you have about financial stability when you're talking about capital buffers? Surely the blunt instrument of a move on the deposit rate would do the trick for you.
Yeah, so I mean, again, this is a decision that the ECB and the Governing Council has to take. I think what's our role here is that we make sure that the financial sector is sufficiently robust to deal with any future shock that may happen, and to also all financial institutions to make sure that they take precautionary measures to deal with future interest rate risk, macro risks, and that is, I mean, the financial stability implications of any measures are obviously also taken into consideration by central bank when they take their decisions. But here our role is to really make sure that we have a stable and resilient financial system that can deal with these future contingencies.
Claudia, as we talk about a stable central bank as well, Jens Weidmann vacates the top job at the Bundesbank later this year. Your name has been touted as a potential replacement. Are you still in the running?
Well, you would certainly understand that I can't comment on that. I think it's in the very good hands of our government.
We were witnessing at this point predictions by Weidmann that you will see inflation peak above 6%, then barely fall to 3% by the end of next year. Are you concerned about this elevated position for pricing pressures in Germany?
Yeah, I mean, this is, I mean, first of all, what one has to say is that with all the different opinions and statements about inflation, so there's one common denominator of all our forecasts, that the increase in inflation that we're currently seeing is going to be temporary. So this is what all the forecasts are saying. I think the differences are in terms of interpretation and also policy needs. The differences are with regard to the elevated upside risks that I see and that we see for inflation going forward. So the inflation rates will decline. The question is to what level and how persistent will this be? And I think what monetary policy has to do is to be prepared for all future contingencies and to act accordingly. And again, what we can do to support monetary policy when it comes to these decisions is to make sure that also there's the financial system is able to deal with policy changes.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.